Throughout history, many market participants were trying to time the market. It is known throughout historical data that this task it is almost impossible. Many fail to time the market properly, making projections and predictions. Today is going to be an unusual stream as we never try to time the market, but in this case we will try to time where the next recession can be. As Milton Friedman once said, the stock market and the economy are two different things. It might be for the same reason, as you guys can observe in the chart. On the quote, it might be for this same reason that participants in the stock market often fail to time the market properly. Welcome aboard, traders, to another session of Charting Across the Board. Today is Thursday, 7th, 2023. As you guys are already familiar, we're going to be navigating different trading instruments across the board in order to identify potential trade setups in the chart. But before we start navigating the technicals on any trading instrument or any index or cryptocurrencies, we're going to be starting the stream today with the Fed funds. Ideally, or many participants believe or have two opposing beliefs where the market will turn severely or if the market will continue its rally. What I'm going to do here is to try to explain based on the data that we have in the chart, in this case on the federal funds for the interest rate currently ranging at 5.33%. Also looking at the historical data on the left hand side, I found this interesting indicator. The coloring here that you guys can observe in pink represent the cutting rate, and throughout history the severity of these rates were also accompanied with major declines in the market, right? Some of them were presenting major downtrends after the peak of the market already. So again, the Fed potentially acted later here, or late in this case. In other cases, only after the peak from the bubble of 2000. Similar case, they start cutting rates after the peak, pretty close to that peak of that time from the 2000. The next one and the major one, we're talking about recessions here. Therefore, the idea is to project where the next recession may be, okay? The next one after was from the major financial crisis in 2008. Also, in the same manner, they started cutting rates right after the peak, okay? The most recent one from 2019, COVID crash basically, similar conditions. So the interpretations that the market will keep running after the Fed will start cutting rates doesn't seem to be correct. That interpretation may be misleading from what we can observe in the chart. We're not having any bias in this case. We're only presenting arguments based on the data, and the data can be observed here in the chart, okay? So therefore, I'm going to make my first time a projected level, a prediction in this case, if you guys want to call it that way. I'm going to project where the next recession may occur, and only base this projection based on the technicals once again. Why? Because we use this charting application from the legends of the past over and over to either spot or to execute patterns as well as cycles. In this case, you guys can observe the cycles here, the sine waves that represent the frequency of the market rhythm, right? And it dates all the way from the 1950s. So therefore, if this is a heartbeat of the frequency for the market, and if we are following the same condition, the same sine waves that determines the length amplitude of the frequency of the market, we can make projections or predictions, if you guys want to call it that way. Okay, you guys can observe the cycle lows. Once again, something to consider here that sine waves only represent the highs and lows. Cycle lows at the bottom, of course, and cycle highs at the top. Okay, the date or keeps beating within the same frequency all the way since the 1954. Okay, cycle low, cycle high, same all the way. Not always perfect, but pretty close to be perfect. Okay, the most recent one was from the 1987. The cycle high, cycle low also from 1993. Back to the cycle highs, back to the lows. You guys can observe here. This is a perfect rhythm, perfect symmetry of this behavior within the fund rates. Okay, so therefore, applying the same analysis, the same behavior of this rhythm, we can observe that after, also something to mention here is that they start cutting rates after aggressively hiking first. Right, the blue horizontal histogram in blue here on the left hand side represent also the period of major hikes in the stock market, or during that period in the market, and afterwards also the cutting rate, right, in blue, or in pink in this case. So therefore, if we are within the same frequency, okay, within the same frequency of this behavior, something to point out here is also the period, or the pause period. The pause period is what I call the flatness, the period of flatness that we also mentioned previously. This range, where they start hiking rate, and before stopping or cutting rate, there is a period of flatness, or a pause before cutting rate. Are we there? We might be. We can be. Therefore, if we are still going higher, I would assume that we are not entering, or potentially entering, the period hike, or the period high from the rates. I can be absolutely wrong. Once again, this is only portraying the same behavior that occur over and over. Therefore, if we're following the same rhythm, I'm willing to make my projection that the next recession, based on historical data after pausing or after cutting rate, may occur, once again, based on the sine waves, the cycles within the market, sometime either, as you can observe, if we use the same analysis, after they stop hiking, there is a period of flatness that we should consider within this range. Therefore, if that's the case, the next recession at this time might be common. However, let me be clear here. Many participants in the market were already wrong since 2022. However, they keep postponing where or when the next recession may be. Right now, they're extending to 2024, which I would agree that there might be an argument sometime in next July or at the end of the year. It can be an argument, absolutely. That will be the first range for the cycle where the Fed may start cutting rates. And also, the bottoming price action can last until October or November of 2025. So that is a period of danger, in my opinion, that the next recession may occur between late or mid 2024 and late 2025. I would suggest, or not suggest, I never suggest, I would agree that I don't want to say bias, because that is a distorted view of the information. Therefore, the approach should be neutral. I would say that the odds in this case may favor for late 2024 and late or early, between early to mid and late 2025. But where can the market go to that point, since we have almost a year from that time? We're in September now. We're entering the last quarter of the year, pretty much. So where can we go in the market? Are we going to be at the same range? What are the arguments that the technicals are going to present back then? There are going to be many of opportunities before this potential downtrend. Now, the severity is something that we do not know. Nobody really knows how deep can the markets go. The S&P in this case, a major index. So therefore, again, I'm going to bring my own analysis. You guys already know, we mentioned since last year in October of 2022 that the idea to be here at current levels, pretty much at the 45 and 46 region, was within the cards, based again on the harmonic ratios that we went over and over. So what can occur if we're not breaking from here majorly? Only to be prepared as traders, because what we want here is to execute many trades as possible. And of course, if we do know when the major market turn will occur, we want to be in the same directional move. In this case, a major short execution, if that's the case, if that takes place from late 2024 or mid 2024 or 2025. Okay? Once again, this projection is mainly on the same frequency of the market, dating all the way from 1955. Not a biased perspective, only applying the sine waves here to identify the cycle highs and cycle lows. Everyone, thank you for being here. Once again, this is Marvop 6. We're going to be moving into the next chart, also applying the same cycles here for the S&P 500. If we move into the same chart for the S&P 500, once again here, this chart corresponds to the federal funds rate. The next one is the S&P 500 that I plotted right here on this chart. Right here also, looking left, market leaf clues. Something to mention also is that there were cases or periods where the Fed started cutting rates, however, the market kept going higher. Right here also, from 1990s, you can observe here, there was cutting rates, but the market was still going higher. That was the only case, in my opinion. Also, a brief breather here, a decline back in 1998, 2000. Similar from the major cases, basically from the bubble, the dot-com bubble, that was signaling major downtrend since then. So the only data, in my opinion, or these two potentially from 1995, also from 1990, 1991 to be precise, January 1991, right? Cut rate, the market was still going higher. Similar case here on 1995. One cut rate, and the market kept continuing going higher. Besides those previous two data sets, the major ones were respected, 2000 and 2008, and the most recent one, of course, the COVID crash right here in this segment of the move. But also considering also that the cuts started only after major hikes, correct? Looking left, the blue histogram island represent the periods of major hikes. You guys can observe these indicators that are called the US Fed rate cut review in pink, and in blue is a US Fed rate hike review. This is pretty helpful tool, in my opinion, to identify or do some charting application if you like to emphasize or fantasize with the idea of the recession. As Milton Friedman said, the stock market and the economy are two different things. Therefore, where can we go for the next recession in the market, in the stock market, the S&P, the major index? Let's give some ideal scenario as to when that may occur. Okay, only if we're not rejecting majorly from here. Okay, again, assuming we're not retracing majorly at these levels. Let's start with the major time frame, the weekly time frame. Let's erase all the data sets here where we are currently. We need current data, fresh data printed in the chart as of now. We are within already the PRC of a major bear structure on the weekly time frame. W formation, you guys already know that W patterns correspond or indicate that major reversal point, or reversal point in this case, may occur in the chart. Since the chart or the pattern was presented on a major time frame, the weekly, the idea is also that if this pattern were to be respected, then major declines should already begin at these levels after the first test of the 0.786. Slightly over spiel, we did have some decline, nearly 6% also, correct? But based on the size of the structure, a 6% move doesn't indicate a major turning point in the market. This can be a harmonic pause based on the cipher pattern. But again, there are variables that we are gathering. We are collecting those data sets. Why? Because on the monthly time frame, we're also aware of the major hanging man, a Japanese reversal candlestick that was printed on the prior month. Therefore, we're being cautious at these levels. But you guys can observe my approach from here now. At the lows, I was not bearish. From here, I am more cautious. But where am I being cautious now? Only after a 30% move, right? The approach is different. The interpretation was the same back then, but for so many Wall Street analysts, and this is not to go and tease them, but for them, the topic about recession was already pretty much since last year, early last year even. We did have a decline in the market, but what occurred after, I believe the upward move pretty much absorbed the entire selling pressure. In many cases, many stocks printed new all-time highs. Nvidia, Apple, Microsoft. I believe Microsoft printed slightly new highs with its current high since October lows. So my point here is to identify only potential setups in the markets to trade accordingly. And if there is indeed an opportunity for a major short execution, of course we want to be in, right? We would like to trade. We're traders. That's the approach. So here, why I'm being cautious, once again, the cipher pattern. We have a major cipher pattern on the weekly. The idea is if there is a retest, which occurred pretty much after the Jackson Hole last week, I believe, we retested the 0.786, 45, 42, and then started retracing back. But there is another key data point here. Which one? The key technical level, the golden zone that now potentially is regarded as support, at 43.19. Okay, so this is a key level to break first before start fantasizing with major downtrends, in my opinion. Okay, based on, in my opinion, my personal opinion, based on my trajectory in the field, is that after recapturing the key technical level, this becomes a key level of support. Why? Because then after recapturing the key technical level, we then have the deepest areas of retracement to be tested, which was the case indeed at the 0.786. Okay, 0.786 turbulences. No major retracement or correction yet. Therefore, the trend remains intact towards the upside until further evidence that the market will start reversing majorly. The first warning sign, in my opinion, will be after breaking the 0.618. Why? Because you guys know that many moves tend to terminate at extensions of prior swings. The prior swing, based on this particular time frame, correspond to the weekly time frame. The highs at 4,800 to the lows. Are we closer to the lows or closer to the highs now? What will be the argument from here on? Double top. We mentioned this also a few months ago. But the argument from here on will be maybe there may be a chance for a double top. Of course, we're closer now, right? 300 points is closer rather than 1,000 points back to the lows at 3,500. Makes sense. But now the key here, once again, there is another key ratio for the S&P 500 to be to challenge. The 0.618 remains as a key support. There is no doubt, in my opinion, as of now, the 0.618 4,300 wide previous structure resistance, also the B point of this W formation, was a key level to break. Now we have a slightly shift in sequence. Breaking higher, decisive penetration, as Gary calls it. There was indeed a decisive penetration because if we compute the measurement in terms of percentages, that represented nearly 7% after breaching higher than the B point. But now we're retesting. We tested once, not precisely at the B point, which is around 43.10 and 42.68 or 58 if I remember correctly. At the candle closes pretty much. 42.70, 42.74. That will be a key level to be violated before start fantasizing with the lower levels, okay? However, turbulences in the market are presented, therefore we are being cautious. Cipher pattern on the weekly, on the daily time frame, also the major butterfly that was presented also in I wouldn't say a year in advance, but way in advance, at least a month in advance, we presented the argument for the bearish butterfly. Also another structure, the PRC at the 1,272, overspill of the PRC slightly, still within the range, at 46.11 or 46.9 was the highest. Turbulences. Now, another key metric also to identify here is that this type of formation, butterfly patterns, are extremely powerful in bearish conditions. So any bearish structure in a bearish downtrend or in a downtrend should ideally outperform any bullish condition. Ideally, in theory, right? This is why these major patterns represent major turning points. A case for this case can be also back in 2021, a butterfly on Bitcoin. There was arguments on the daily, on the weekly. The prices were entering the exhaustion period at the PRC before the major decline that we all experienced back in 2021. So therefore, once again, based on the research, these type of patterns represent, these are extremely significant bearish structures. But if we start to seeing that these patterns are underperforming, that means also that something larger, of a bigger magnitude, is developing on larger time frames. Once again, we have a daily pattern. We were expecting this move since pretty much the lows. We presented arguments, not since the prior lows at October lows, but after completing the C leg of the move. Correct? That was an idea to speculate since then, December of last year. Since then, upward momentum, consecutive higher lows, construction of an uptrend. So far, there isn't any violation of the prior lows in this case. That in this case, will be pretty much at 4,000 in my opinion, or at least if we are 43,000. Let's put it 43,000 because this is a key technical level now. Key inflection point to be violated. If that level gets violated, we then know that maybe lower levels may be in the card. And also, the idea will be to not only break below, but also to retest as a confirmation and solid conviction that the market may start heading lower once that level is being regarded once again as resistance. As of now, this level remains as support. Okay? So therefore, if we're not breaking from here, right, where can we go? I presented the same arguments 2 months ago, or last month, I believe, on the prior cycle analysis, or a brief presentation of that period. The idea was that if we're not breaking from here, I'm already starting to present and start gauging the data points in the price action. If we're not breaking from here, the arguments now leads me to believe that if the cipher pattern, you guys already know that cipher patterns and shark patterns are similar in the formation, but they differ at the PRC, at the completion point, either at the 0.786, correct, which has been the case as of now on the weekly time frame. But if price continues to navigate higher without violating first the 0.618, 4,300, this is a key level of support. Therefore, we know that as long as we remain above the 0.618, there might be a chance also to recapture not only the 0.786, but also the 0.886 at 46.74. This has been the case already on the S&P futures for the CME chart. And then, of course, from there on, we have the potential case for double top, right? And then, again, the U formation. Maybe an early formation of a cap and handle, right? We do not know. That can be, that's always the case for early identification patterns. Double top, the correction of the candle or the correction of the channel represent usually or typically the correction period for the handle. And after breaking higher than the supply zone, we then have the measure move. That would be in an ideal scenario for bullish conditions, right? Only if, but that's not the argument here. My argument here is that if we are going higher, only if we're going higher from here, we do know that shark patterns, potentially my least favorite patterns, are shark patterns. Why? Because the wide range of ratios between the 0.886, the 100%, the 1.13, and not only the 1.13, but afterwards, let's assume this one can be the case. We have a shark pattern at the 0.886. It's still a pending pattern at the 0.886 for the S&P. So far, we have a valid bearish structure. There is no argument. There is a valid bearish cipher as of now. The argument next one or afterwards goes to the 0.886, 46.74. The next one for the double top that we may see, I do not know why, but I have a feeling. My gut indicator is telling me that I might be absolutely wrong, okay? until further evidence. But until, I'm gonna make that as a variable, as a conditional characteristic for the S&P to be violated first. Only if we're not breaking below the 0.618, I will start seeing later on potential double top arguments at the 100%. Let's remember, September 7th. From here on, in 3 months, we are going to be at the monthly candle close or the yearly candle close in 4 months. So the next one after the potential double top for the shark pattern, this is what I said is my least favorite pattern, is based on the range, right? You need more arguments for these type of executions. The next one goes to the 1.13, okay? Can this last until 2024, mid 2024, 2025? Absolutely. Major shark pattern on the weekly time frame can be the argument. That will be, again, 5,000 region. I'm not suggesting we are going to go there, guys, okay? Only projecting harmonic ratios the same way we did at the 0.786, okay? From the lows, the same arguments. I'm not suggesting we're going to go there, but only presenting arguments based on harmonic patterns, harmonic ratios, that if we're not breaking below the 0.618, let's be aware, at least, let's be aware that the deepest areas of retracement are ranging from the 0.786, which we already tested. It can be tested multiple times also before majorly reversing. But we need to find those patterns on the 4-hour, the daily, the weekly, and so on. Therefore, on the 4-hour time frame, you guys are already aware that I'm looking for a W formation, a very bad pattern, at least for a potential retest of nearly those highs, and then maybe start reversing. Of course, we're not there yet. That level should be around 45 and 80. Okay? But once again, once we violate the 0.886, all the deepest areas of retracement, we know that many moves tend to terminate at extensions of prior swings. The 0.886, the 100%, 48, 46, potentially a double top, and then, of course, the shark pattern, the extensions of that failed wave, also known for harmonic ratios, that normally goes to the 1.13 for a major, very shark pattern. If there is no major violation at the 1.13, a 5,000 region on the S&P, can you guys imagine? I can, but many cannot assume that can be the case or digest that information yet. But let's be prepared for any type of outcome in the markets, okay? Now, the tricky part of shark pattern is that if there is no major violation at the 1.13, we then have the ratios, the complementary ratios between the legs B to the D point. And this one ranges all the way to a 200% between this leg, okay, right here. The B to the D, that will be around 51.39. The 2.14 or the 2.14 will be around 5,200. And then the next one, the major one, should be around the 224. That is the last range for shark patterns, okay? Either bullish or bearish in this case. 224, that will be pretty much at 53.33, lining up also potentially over spill around 53.95 at the 1.41, another key harmonic ratio and identifying as key turning points in the market. My argument here is not to present an idea that we are going to go there definitely, okay? I never know what's going to happen in the market. I only act upon the information that I perceive in the market. If there are divergences, Japanese reversal candlestick at a key inflection point, prior structure support becoming resistance of buy or vice versa, in combination with other harmonic structure in major time frames, I execute a trade where the risk is lower. That is all what trading is about. Executing trade at a lower risk area where the reward should ideally be higher, right? Or an area where the risk can be easily mitigated. It's not a perfect game. Therefore, we are trying to shape those minds to become better traders. Okay, so this is the argument. That can be the argument. Why this argument? Because this one, I already presented previously, this one can be the same case that was in the case for Bitcoin last year. We experienced that if that's the case, if we have a major shark pattern at the 1.13, we then can potentially have a major cipher pattern also, a bullish one, but potentially navigating only if we're not breaking. Once again, if we're not breaking below the 0.618, as long as we remain above, this C leg of the move can still remain either for a bad pattern at the C point, because we know that the C leg for bad patterns can range from the 0.382, that we are way above now, all the way to the 0.886. Therefore, this is the last level for a pending C leg for a bad pattern in the event of major downtrend, okay? And therefore we can then compute the PRC, the 0.886. But what happened after if we violate the 0.886? Well, we then have the argument for what? The cipher pattern. This is one of the trickiest patterns because it tricked market participants becoming bearish, extremely bearish at the C leg, which is the same case. You can observe here, we have a perfect argument here, extremely bearish at the C leg of the move, but what occurred after? Major upward move of 32%. So therefore, now that we are in euphoria mode, right? The AI BS, the narrative about markets are going to keep going higher, it can be the case, but the argument for to be more cautious now increases in my opinion. Why? Because we are now debating between either the C leg of the move of a major bad pattern, right? If we reject at the 46.94, but if we keep going higher, I'm also being prepared, understanding that a major cipher pattern that has previously occurred many times can potentially be the case again for the S&P 500. Either the first test will be at the 1.13 or between the 1.09, 1.06 if we are permissive, also for ciphers at 5,000. And from there on, we have the 1.13 afterwards, coinciding also with the FIB extensions, 51.93, and the last one, the 1.41 is the last one. Unfortunately, again, not making projections here or predictions, will be around 6,000. This is pretty much David Hunter argument. Okay, 59.40. I'm not making a prediction here in the S&P 500, only trying to time the market as to what are the levels that we need to be aware of based on harmonic ratios and act accordingly afterwards, having a confluence with patterns. If we go to those levels, we then know that we have a major shark pattern that can go all the way to 5,300, okay? In this case, right here. The 224 is the last level here. So ideally, a short execution at 53,000 will be maybe the major case where C leg of the move for a pending cipher that can take a decline. Many are predicting 80%, but let's see what the correct number may be. Can be around 47%, all the way to 50%. From here on is where I'll be more cautious. I'm cautious already at these levels. I said it before, 45, 46 is where I'll be more cautious. And moving on from here, this can be an argument for not only the completion point of a cipher, but also another variable. Higher high than the prior high leads to potentially divergence, correct? Higher highs in the price action, many euphoria or the sentiment might be euphoric among the participants at that level, and also within the RSI, potentially maybe on the monthly, based on the symmetry, this may be the argument. We presented already this argument before, but only bringing the idea now. Why? Because this can be the case, okay? And also on the RSI, major divergence, right? Triple bearish divergence. The prior high from 2017, lower high from 2021, and now maybe a last retest between 2024 or 2025. This Y also coincides with the projections and potential cut rates from the Fed funds sometime between next year, summer. Will be a key level to monitor. If they start cutting, of course, we need that period of pause, period of flatness, or the pause period also, okay? And that may coincide also with a major downtrend. I can absolutely be wrong, and the market can absolutely tank from here because we have a hanging man. But for that idea, I'm tracking. I'm also being prepared here. I'm not being aware. I'm not being disconsiderate of what we have currently in the price action, because on the 4-hour, to me, we have the pending formation that I presented previously. This bad pattern. Now, also after computing new data sets, the current high, until of course breaking higher, that can be maybe an argument for, if we plot from this anchoring point, maybe a butterfly now. Why a butterfly? Similar characteristic here. The anchoring point from X to the A, now the B point, constructing that C leg of the move that can range all the way to the 0.886, and until now breaking below the prior low of 43.36, maybe an argument to the 12.72, a retest at the 46.80, also in combination, in confluence with the 0.886 on the weekly for the shark pattern. Okay, can be an argument here. Again, these key levels, this prior lower high, or this lower low in this case, this low, the pivot low as of now, is also another key leg of the move for pending bearish bad pattern, the one that I presented previously. That can also be the case, okay? But then of course we have new data sets in the price action, and new harmonic ratios are presented, and therefore the symmetry also changes. Now, I'm not as convinced now for the bad pattern here, because maybe at this leg of the move, the symmetry was more proportional. But now, since we have new information in the price action, maybe we're printing, once again, new information. C leg, the B point, the new information that we have is pretty much the B leg of the move for maybe a pending butterfly again, as long as this is the key support level. Where are those levels on the S&P that we mentioned that needs to be respected? From the lows to the highs at the 0.618, once again, 44.14, based on this time interval on the 4-hour. Therefore, this is a key level to hold as support in order to determine that that may be the case. As of now, we tested the 0.50% retracement of 44.38, slightly over spill, 44.31, okay? Key level here for the S&P also. As long as we're not breaking below 43.36, we can have the argument for potentially the bad pattern at the 0.886 or a butterfly around 46.69. That will be pretty much slightly higher than the prior high, also within the range for the major time frame on the weekly. Okay, so I hope this helped you to understand my trading approach. Basically, this is the way I gauge ideas. Also, previously here we have major divergence, class A, printed. No, many participants did not. They completely ignored this data set on the weekly time frame, making still projection from here lower levels. However, that was a major support, and since then we are 30% move higher. Okay, of course we cannot anticipate or predict these type of moves, but the variables in the chart can give us a notion applying traditional charting application. Okay, so this is why from here on I'm more cautious. All right, can we go higher? Sure, but let's have that perfect execution in order to time the market, or at least try to time the market based on the tools that we have. To finalize the stream, I'm going to touch briefly a point on Bitcoin, because the idea here comes from the same argument, the euphoria that was presented previously on Bitcoin, the 100K. Everybody and their mother were yelling, or everybody and their siblings were yelling 100,000. We tested where the C leg of the move of a cipher, and then afterwards a major decline. If we reconstruct the prior events here on the weekly time frame, that was the case here, similar case. Pretty much we are either here between this leg on the S&P, right? But the idea here is to not become extremely over bullish at these highs, okay? 48, 5,000, what else? Is a pretty close level to have a major decline, since if we go higher. But also we want to be in either direction. If we are going to go to those levels, let's find a bullish pattern to retest those highs and take advantage of the opportunity, and then switch gears back to the short. Okay, that is my motto and has been for the past few years. Here is the idea. The C leg tested the 1.06 and then major decline. $100,000, $200,000, 1 million Bitcoin. Absolutely major nuke in the price action. Nearly 80% move, 77% move. And now, of course, we tested the PRC of a major cipher pattern. And since then, 15,000 region, we have a major move of 100%. Extremely at the lows. You guys remember the fear? Similar characteristic here. Extremely euphoria in the 60,000 region. We indeed posted a short pretty much at the top back then, 69,000, without even knowing that was a major top. But it was. Did we know? Absolutely not. Now, the major low, 15,000, was also where the extreme fear came into place. From the FTX saga and all the BS going on around the crypto space, right? Extreme fear at the lows, pretty much as the S&P 500, and now we are here. So my approach is to present solid arguments with an unbiased perspective, therefore we can be prepared for either direction. Everyone, thank you for being here. This is Marble6. And I'll see you guys on the next one. And I hope this video or this stream helps you to get into a trading mindset with an unbiased perspective, because any distorted information that we may perceive or try to force in the market can certainly impact our next trading decision. Everyone, thank you for being here, and I'll see you guys on the next one. And remember to live a life with an attitude of gratitude. Cheers.